I think the market volatility at the moment is a reaction to tighter liquidity on the one hand, and on the other hand it's a reaction to the earnings numbers which are coming out, which are okay but not as good as investors would have expected, given high valuations in the US and given some doubts about global growth affecting Europe.
I want to just pick up that point on a resetting of expectations, because in the States we're getting used to a 20 handle on profit growth, and now the market's gone, well, it's going to be 10% really for 2019. That's quite a significant shift. Even if you are still enjoying gains, it's not the heady gains you're used to. How does that context come across to the European earnings, and what sort of expectations reset are we seeing here?
I think to be fair, 20% earnings growth in the US was expected to be temporary, so you couldn't expect that to hold on for longer. So you should expect something like 10%. For Europe, I think the hope has always been that we would have been able to reach the 10%, the double digits in Europe as well, and still we haven't been able to do so, and that's kind of discomforting.
Can I just pick up on the first point you said is a function of dwindling liquidity in the system? In Europe, there hasn't really been dwindling liquidity yet. ECB haven't actually started. Haven't completed their QE program, and they're going to do that in a couple of months' time. Reading between the lines, if European equity performance has been this bad this year, is it going to be worse next year once the ECB actually stop their quantitative easing program?
Clearly, we hope not. And on the one hand, the fact that liquidity is tighter is affecting emerging markets. It is not affecting the US, because the US can deal with the tight liquidity. That's the whole reason that liquidity is getting tighter, because growth is firing on all cylinders. Europe is kind of in the middle, and we wouldn't expect that a tightening of liquidity in Europe, if it is a reflection of higher rates and no need for unconventional policy anymore, that would necessarily mean that European equities would stall.
It's almost as though European equities have been at the nexus of every negative narrative that's being played out. The liquidity story, the exposure to emerging markets, the trade story as well. Obviously, a lot of these indices are very export-oriented, which is one of the reasons why the DAX continues to suffer on the down days. And so where is the constructive story in Europe going to come from?
At Kempen, we feel that if central banks if the ECB raises interest rates, that would be constructive, because it would be a sign that the economy can deal with higher rates, that the situation has normalized. If you analyze the entire European data story, the economic story, the weakness has all been externally led. It's not domestically led.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.